Good morning, everybody. Welcome to this week's episode of DoubleLine Minutes. I'm Eric Dhall here with Ryan Kimmel.
Yo.
It's shortly after 10 a.m. Pacific here, August 22nd, 2025. And boy, what a week it's been. Somewhat of a bearish week in equities until the Jackson Hole meeting that just transpired about 3 hours ago. But we will save that for the economics discussion. So looking at the bloodless verdict of the market this week, the S&P 500 is up a meager 20 basis points as of the recording of this podcast. But, if we looked at it as of yesterday, it would have been down. The market, the S&P 500 is up over 1.5% right now. And a lot of that came on the backs of the commentary from Jerome Powell's speech given at Jackson Hole, leaving the rate cut window open. Moving in, looking at the sector returns of large cap equities in the U.S., the technology sector was the weakest sector this week, down about 1.3%. That was followed by communication services, down about 0.5%. The best performing sectors this week were energy, up over 3%, and real estate, up about 2.75%, followed very closely by materials, up about 2.6%. So pretty interesting dispersion this week. If you look at the Russell 1000 growth, the Russell 1000 growth dropped over 1% this week, and the Russell 1000 value climbed almost 2%. So quite a spread there. And if the S&P equal weight up almost 4% on the week. So diversified investors were rewarded this week, and investors who were all in on mega cap stocks suffered a little bit of punishment. As maybe there's some consolidation, there's some questions as to if the AI animal spirits can be maintained at these levels of capex. Just as a brief aside on that note, I read an interesting piece this week on from a professor of psychology and neuroscience, and the human brain runs on 20 watts. And according to this guy, in order to get an AI model with enough parameters to match the human brain, you would need several gigawatts of electricity, the amount of electricity needed to power the city of Dallas. So there's definitely some efficiency problems in this AI technology in its current form. And his call was more of a call for more research in kind of the architecture of brains and that sort of stuff, trying to find ways to do this AI-like technology more efficiently than just building these massive data centers with huge numbers of chips and huge amounts of power draw. Now, we'll have to wait and see if there's a catalyst there, but as of right now, the market's still relatively sanguine, but tech did sell off this week. Over in fixed income land, it was kind of an interesting week because rates initially sold off. They initially sold off this week. We had the 10-year trading at 433, but as of we're recording right here, the 10-year trading at 426. So, on the week, rates are up a little bit, but I mean, rates have consolidated down from those higher levels we saw earlier in the week. So they've actually, on a week-to-date basis, dropped 6 basis points at the 10-year point of the curve and dropped 4 basis points at the 30-year point of the curve. The 2-year has dropped 7 basis points. So that's kind of where we're at from a rate perspective. So the fixed income markets have performed pretty well. The broad Bloomberg aggregate is up over 0.5% on the week, and it looks like green across the board in all of the subsectors. Governments are up. Mortgage-backed securities are up over 60 basis points. Corporate debt is up in both the investment grade and below investment grade parts of the credit curve. And bank loans are up, and emerging market bonds are up about 40 basis points. So pretty positive week for fixed income investors out there, which is somewhat interesting. I mean, a lot of this, there's a lot of stuff going on in the economy right now, and we'll kind of dissect that when Kimmel leads us off on the macro front. Looking at commodities, the broad commodity index was up 1.3% this week, and the energy subcomponent was up 34 basis points. WTI crude rallied, and it's currently trading at 63.5, up almost 3% on the week. Copper was down 0.5%. Gold up 1%, currently trading at $3,370 an ounce. When we go over to crypto land, Bitcoin dropped this week down to 116,000, and the dollar index currently sitting at 97.7, relatively flat on the week, down 15 basis points. And that kind of rounds out the kind of weekly performance, but it was one of those weird weeks where things were grinding lower, and then we had a big news event today that kind of shifted things. What do you think, Mr. Kimmel?
Yeah, I mean, obviously the main event of the week was Chair Powell's Jackson Hole speech, where I think the market heading into his speech was, expecting a bit more, hawkish tone from Powell, a bit more balance, kind of leaving the door open for maybe we'll cut rates at the September meeting, maybe we won't. It all depend on the economic data that we get over the next couple weeks. But I think pretty by and large, it came in, the tone of his speech was a lot more dovish, really signaled that, a September cut is likely. He highlighted the downside risk to the labor market, kind of how that will kind of rein in any risk of upside inflation. I think the market's really taken that in stride, and it's driving markets across both equities and fixed income. I think what's interesting, like on the equity front, pretty significant rally, like big catch-up trade really on many of the sectors that kind of underperformed year to date. They're starting to catch a bid. And it's interesting. It does seem like you mentioned it with that one article about AI. It does seem like the news flow this week, or even the last like couple weeks, has been a bit more negative on the AI front, kind of like reining in some of those super optimistic expectations, and that kind of leading to that relative underperformance versus some of those other sectors. And a notable thing is small caps are starting to outperform large caps. Big move on the day. And one thing I'd note there is that small caps, a large portion of their debt liabilities tend to be more floating rate compared to the S&P 500. Most of their debt are fixed rates. So if we do get a series of rate cuts, it's just an instant help on the debt service side for small cap companies. I think that's leading to some of the outperformance there. And obviously, as you mentioned too, on the fixed income front, saw pretty big bull steepening of the curve as the front end rallying more than the long end as more cuts are getting priced into the market. Looking at like the 2s 30s spread, 120 basis points. That's a cycle high now. So seeing the curve kind of break out of a little bit of a consolidation range, and that makes a lot of sense to me. If the Fed is going to cut in a vacuum and maybe put in the inflation risk kind of on the back burner, that to me speaks to a steepening trade.
Yeah, I agree. And I think that at least one of my interpretations from Jerome Powell's kind of comments at Jackson Hole, he kind of he really talked about the structural changes in the economy and how the Fed can't really control that, and they can only look at the cyclical components. And what am I alluding to when I say structural changes? I'm alluding to price increases due to tariffs, which you would think would be a one-off price increase, and you would think about decreased supply in the labor market because of immigration policy. And those are structural shifts that the Fed isn't in control of. But then he starts talking about the cyclical components. And he says, from a cyclical perspective, he thinks that perhaps the labor market's weakening and it's more in peril, or it's closer to a tipping point where you could see unemployment rise, given the what he considers moderately restrictive rate environment we're in from a monetary policy perspective. So I think that that's the dance he's trying to play, or at least he's trying to thread the needle there from my perspective, and leaving this door open to cuts because of the weaker cyclical side of the economy in the face of, potentially some headwinds on the inflation front and the labor market front from structural shifts. That was my take.
Yeah, that makes sense to me. And the the shift to a more dovish tone since the the July FOMC meeting makes sense because of that, the July payrolls report that they received like a few days after their meeting. That showed in a labor market that was definitely, decelerating on the margin. Pretty dismal given those significant downward revisions to the previous 2 months. So, you know, by and large, the dovish tone makes sense in my view. So with that, I guess we'll switch over to economic data that we received this week, which was I'd call tier two, tier three data. Um, a lot of the data was focused on the housing market, kind of mixed. But on Monday we had home builder confidence that came in weaker than expected. It remains near kind of cycle lows in this like post-COVID era as buyer activity remains muted. On Tuesday, we had housing starts that actually came in a bit stronger than expected. It increased 5% month over month for the month of July. And that was largely driven by a rise in both single family and multifamily starts. Building permits, though, on the same day came in a bit weaker than expected, down 2.8% on the month. We had the FOMC minutes from the July meeting. Those are kind of stale because, as I mentioned, the meeting was before that week July payrolls report the following Friday. Then on Thursday we had the initial jobless claims, which showed a little bit of an increase. It increased 11,000 to 235K. That brought the 4-week moving average up slightly to 226,000. Still no real warning signal there. On the continuing claims front, that rose 30K to 1.972 million, which actually the highest level since November 21. So, we are seeing this kind of slow rise in continuing claims. But it's
I
not
think,
really.
yeah, and I think that's a good point. That like slow simmering, continuing claims, that's kind of this underlying weakness that I think Chair Powell was referring to, is that when you lose your job, it's harder to get a new job, and so you're just kind of stuck there in purgatory a little bit. I don't know. What do you think?
Yeah, that's right. It's just signaling that it's just taking longer for laid off workers to find jobs. We're seeing just like very low turnover across the labor market. Both hirings and firings remain very muted. So it's just kind of this like static, kind of slowly decelerating labor market. Then also on Thursday, we got an update from S&P Global, their US PMI report, their preliminary reading for August. It actually came in pretty strong relative to consensus. You had the manufacturing component come in at 53.3. The consensus was expecting a sub 50 number. So pretty strong report there on the manufacturing front. Services segment that was 55.4, relatively unchanged from the previous month, slightly above the consensus. And what's interesting when you look at the like employment components of this report, it was kind of signaling, strong readings, or at least expansionary readings, above 50 on the employment component, which is a pretty significant uh discrepancy to like what you're seeing in the ISM numbers where the employment components are in contractionary territory. So definitely mixed signals from these PMI numbers, depending on your data source. Another interesting element or highlight from the global PMI was the prices paid component, and definitely seeing some upward pressure there on prices paid both in manufacturing and the services component. So perhaps signaling some upside risk to inflation over the near term. Also on Thursday, we got the conference board's leading economic indicator. It declined 10 basis points in the month for July, in line with consensus. So the year over year rate that declined 3.6%. Your 6-month annualized rate a little bit worse, down 5.3% on an annualized basis. But this, I don't put too much clout into this indicator. It's been, signaling economic contraction for, I feel like, a number of years now. It's just, but maybe, broken clocks, right? Twice per day. So, um,
And that thing just needs to be the model needs to be rerun. All of the regressors need to be redone. The whole thing needs to get recalibrated. But we'll wait for them to do that, and then we'll update our listeners when it happens.
For sure, for sure. And then finally, also on Thursday, we had existing home sales. Those rose 2% on the month. Um, Single family sales were up 2%. One interesting thing is that the median existing home sale price that had decelerated down to basically flat on a year-over-year basis. Which, I think, and we've been highlighting this on these calls for a number of months now, is that, I think that puts further, downside risk to the shelter inflation component. Um, I think it could be running from somewhat elevated numbers now to maybe even like lower run rates than we saw pre-pandemic. So that wraps it up for the economic data released this week. Pass it back to you, Eric.
Yeah, thanks, Brian. I think that was a good update. I mean, like you said, it was kind of Kimmel's tier 2 and Kimmel's tier 3 of economic data, but it wasn't the most market moving stuff, but definitely useful to keep our eye on the ball there. Just looking at the interest rate probabilities right now on the US rate curve. So traders are currently cutting in about an 86% chance of a cut at that September meeting, and that jumped from like the 70% range probability range, before Powell's comments. So I think that's really the catalyst for the surge that we've been discussing and that you see happening. And looking out to December, though, only 2 cuts. So the concept of like the 3 cut happening, at least right now, doesn't look like it's going to materialize. But we'll have to wait and see. 3 cuts by year end, 2025, that is. Kind of looking out to next week, I think we're getting definitely some tier 1 data next week. What do you think?
Yeah, some tier 1 data after a very slow week. To start off the week on Tuesday, we're gonna get durable goods. That always is helpful, kind of give an indication on, what investment spending may look like for the quarter. We'll also get an update on continuing claims as usual, given the weekly data frequency. And then we get an update on personal income and spending, and most importantly on PCE prices. And I think that's going to be the main data point for the week. So it'll be, the CPI, or sorry, PCE prices for July. The market or economists are expecting a 30 basis point month over month increase, which should bring the year-over-year number to 2.9%. Again, this is on the core number. There tends to be less of a miss on these PCE price series because, economists get a pretty good read when they, put CPI and PPI and import prices into their models. But it is looking like, a bit of a hot number. I think the Fed would be, hoping more for like, you know, 10 to 20 basis point month over month changes versus the 30 basis points that's expected.
Think that these are going to be important numbers, like you're saying. I mean, at this point, the predictions are usually pretty good, so those estimates might be accurate, but we're just going to have to wait and see how it shakes out. And that kind of wraps it up for the week.
Yes, thank you to our listeners out there today on DL Minutes. Hit us up on X at DLine Minutes or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
You can find more information about DoubleLine at our website, doubleline.com. Don't forget to subscribe to our YouTube channel at youtube.com/DoubleLine Capital. Thanks for tuning in, and I hope everyone has a great weekend.
Thanks, everyone. Take care.